so much, panel members, Anuj, Gaurav, Rochelle. Thank you for joining us here. We are a very small, intimate community of family-managed business entrepreneurs. Collectively, we were just speaking this morning, collectively, the entire batch of 4,000 students till date manage about $50 billion in revenues. Can I get a huge shout out for that, please? The topic for today's session is attracting growth capital. And the panel members today have very diverse interests in that space. Anuj coming from the VC perspective, Gaurav from everything on the BFSI side, right from wealth advisory, from investment banking, from private equity, and Rochelle, obviously, one of the finest private equity funds in the country, Lighthouse. I think we can get started. Sumeet, any introductory remarks?
Oh, yeah, you can start.
My first question is to Gaurav. Given that you've seen the landscape so closely and the evolution of this has been remarkable in the last 1 decade of the entire growth capital suddenly becoming so relevant in India. Do you see a change in the mindset of family businesses, of some of the businesses that you've backed? How open are they to emotionally get detached from their brick and mortar business to finally be able to get comfortable with raising external capital? Have you seen a change in that mindset?
Hi, good evening everyone. So, I think, so we've been doing, and personally I've been involved with growth capital for last 20 years. And 95, maybe 100% of businesses are entrepreneurs or entrepreneurial teams. So, apart from the latest wave of digital, most of the businesses in India have been owned by family businesses, first, second or third generation. The way I see this, Ankit, and all of you is, every 5 years, for the last 20 years, I've seen a significant shift in mindset of the families to engage with external capital. For 2 reasons. One is the market environment to grow and continue to drive value is getting more complex. Number 1. Number 2, the family member themselves, I've seen now a lot of family businesses started, in our view, in 80s and 90s. And there is, across the board, one of the key triggers for embracing external capital is leadership change or generation change. We are finding that a significant reason for embracing change. We are also finding a change around multiple family members coming together in next to next generation, and how to kind of create a future where different people may be dislocated in terms of what they want out of life. So that's on the internal businesses side. And secondly, the capital markets have, on the private side and the public side, have got much deeper. So there are solutions available practically for everything, whether the family wants to raise a minority capital, whether the family wants to have a majority capital, whether the family wants to exit fully, whether some family members. So the solutioning has become very deep over the last 10 years. So clearly, from a mix of need for the family to find future and the solutioning available in the market. And you will see this happening more and more in a much deeper way. So you'll see markets for family, capital solutions for family-oriented businesses. You will see even more activity over the next 5 years.
I mean, and this is for every form of capital, whether it's equity or debt. Is that a safe thing to say across the spectrum?
It's across the, see, debt capital has been available in terms of plain vanilla debt forever, right? 20, 25 years. So, it's about solution capital in either in the form of equity or structured debt. Plain vanilla bank debt has been available for well-run businesses or otherwise for a very long. So I'm just talking about solution capital, which will actually solve the equity or equity-like solutions.
I mean, so next question to Anuj on the same lines, given that there is so much capital already available on the table, but there are also some new forms of capital, including structured debt, venture debt, uh, private equity, and given that, at Venture Catalyst, you have a dedicated fintech fund, the Beams Fintech Fund. Uh, how, how are you thinking about this entire space of non-dilutive capital versus dilutive PE capital?
Yeah, hi everyone. Hi to the panelists as well. Probably the least experienced in terms of the panel, but my view when you're saying non-dilutive capital, it's more tilting towards debt. Now debt could be structured debt and vanilla debt, which has been there for such a long time, and there are new products which are cropping up like a venture debt product, which is very nascent in my opinion in India ecosystem. Just to maybe give some perspective, probably venture debt is the deal size which has happened over the last year should be close to 0.8 billion versus a structured debt. The deal size which I was just looking at data, actually it's almost 2.4 trillion. So definitely there is a lot of capital which has been consumed on the non-dilutive side when it comes to venture, when it comes to stages at private equity level or even late stage or post IPO as well. So it's evolving. Definitely an option which a lot of growth companies should definitely pick up, because for founders, and this debt capital always follows equity capital. That's how it has been. If
Right.
there is sufficient cash flows in terms of equity which is lying, then only you are able to command debt capital. So both in some form will go hand in hand. You may not be able to raise debt without having sufficient equity capitalization in the company. But founders have to pick and choose because they don't want to dilute, and if it's available, more importantly at right cost of funds. Sometimes they go at very high cost of funds, which in long term becomes a negative for the company as such. So they should be aware. Anything around 12 to 15% IRR should be okay when it comes to non-dilutive. Beyond that, in growth stage companies becomes unsustainable. So it's growing, it's pretty nascent in India as far as venture is concerned, but structured debts, vanilla debts has been there and in biggest in terms of market size. Compared to private equity, probably the deal size would have been closer to $40 billion versus a 2.4 trillion. So debt is much more tilted in terms of deals.
And I mean, that's very interesting because you said that the debt has to follow equity. And for folks who have already, sort of reached their covenant with their banks and they don't have any more secondary collaterals to raise any more money from the bank, for family businesses, when is the right time to go after venture debt? Is it when they are in a hyper growth stage, when they are just scaling up so quickly? What is there a stage, or is it just the requirement for the business?
So first of all, institutional venture debt typically is available only at a growth stage. It is not available at early stage as far as India is concerned.
Right.
It may be available only when companies have typically raised us in terms of venture-backed companies, Series B, Series C stage. Otherwise, large capital is not available, and there are very limited players in India who are doing that. So the availability of capital itself is at that stage, and the venture debt models are thriving on generating IRRs anywhere, including the warrant options, etc., anywhere from a 21 to 23%. That's what they're looking for in terms of earning wherever they are deploying money. This is a composition of the debt coupon rate as well as the warrants which they take, and therefore it's very high cost of funds. if you are a family office and looking to raise venture debt, if it's sustainable enough for you, only then you should pick it up. That's my view.
Stay on that thought. Maybe we'll just change the course of our discussion a little bit with Sumeet.
Yeah, so Rochelle, this is for you. You have been investing in the family business, majorly in the funds. And whenever you invest in the family business, there are structural changes, like in our company as well. So suddenly we start hearing we want CEO, we want CTO, we want CMO, we want CSO, Chief Strategy Officer. So nowadays, and now it's like, you know, the main consultants as well. So of course, you have like structural changes done in any of your investment done in the organization. And what is the best potent combination when the family and the professional works together? So can you share some of the experiences about that?
Hello? Yeah. Thanks for the question. For the audience's benefit, what we typically do at Lighthouse is we are a growth investor. So we end up investing in family-oriented businesses. To give you a small metric, we've done 29 investments historically in the last 15 years, out of which almost 25 of them are very typical, traditional family-oriented businesses. And 3 of them are actually SPJIMR alums as well. Just to give you that input there. So yes, thank you. Just so that's the reason I'm here as well, because this is a fantastic place to sort of talk to you about what we do. Now, Sumeet, coming to your question, look, I don't think there is a particular combination of what is good professional percentage and what is good family percentage, right? Let me talk by cases. You know, today, private equity as a concept, most families understand what it is. 10 years back, people could not understand what equity was, right? People understood what debt was. The reason to take private equity is that it is a capital plus plus. We call it capital plus plus. Because, look, color of the money is green, right? You can take debt, you can take equity. But at the end, what is it that the capital brings along? So, for instances, when, you know, I speak with promoters, most of the times the challenges are, you know, they have difficulty to think about, they got from 0 to 100, let's say, right? 0 to 100 crores of sales. But to get from 100 to 1,000 crores, the infra that you had, I'm not talking of capex infra, I'm talking of the overall infra of the business, will be very different for what you need to get from 100 to 1,000 crores. So families today are very mature to understand what their limitations are. So when we come in and have conversations, we actually try and fill those gaps. So the families can say, look, we have a fantastic product, we may be very good at manufacturing, but we may not have the sales and distribution capability, or we may not have the ability to go to the export markets. So we identify what those gaps are. Hiring is one aspect of it. So, for instance, many a times promoters find it very difficult to hire talent. They don't understand how to incentivize, or the intentionality is there, but how to do it is not available with them. So we make all these resources available. So at the end, we fund companies where the promoters completely run the business and they haven't given up control. So we are only minority investors. So they are in the driving seat. And what we do is actually become the extended bandwidth for them. Not only in terms of hiring a CFO, any kind of CXO, but it is also providing additional expertise. And at the end, I always tell promoters this: you don't require equity. If you want to achieve your plan, if you say you have a 5-year plan to get from X crores to Y crore of sales, if you don't want to change the growth trajectory, right, then don't take equity. But if you want to reach X to Y in a shorter period of time, and you have that ambition, then only take private equity, because it is the most expensive form of capital. I'll pause at that.
Great, Rochelle.
I mean, just picking up from that, I probably will go back to Gaurav to finish my question that I asked him at the beginning of the discussion. Given that, Gaurav, you have pretty much you've verticalized the entire business into investment banking, wealth management, and private equity. I can manage a 15%, 20% return and better than the wealth managers, and that's usually a common notion. We started off like that back in 2015, and then we set up our family office in 2016 formally. Still one of the first few family offices, and we sort of burnt our fingers and then learned it the hard way. But do you still think that notion exists, and how can we change that? Is there more education required? How can that evolve?
So, Ankit, great question. And so I think, first of all, we need to understand the whole managing wealth is a very nascent industry in India, extremely nascent. If I asked all of you, let's say you run a business with 100 crores of net profit worth, take a number, 2,000 crores. And I asked you, what would you do to take that 100 crores and make it 200 crores of profits? All of you would have some or the other strategy. You understand all your businesses extremely well. And you would kind of give us some strategy. You will probably reach there in X years or Y years, but we'll get there. Let's say that business got sold for 2,000 crores. And I said, how do you convert that 2,000 crores to, let's say, 4,000 crores or 3,500 crores? That is a very difficult task. So making money on money, probably, and ask Rochelle here, is one of the most difficult tasks in the world today. There is crazy amount of liquidity floating around, which if you are a seller of equity, you are a deep beneficiary of. But as soon as you start managing money, you are a buyer of equity or buyer of assets. And then you compete with crazy amount of capital that's floating around. So to me, that's the context. Second is the talent in the industry on managing wealth is very early in this country. Very, very early. Most of the money is being managed around trusted advisors, people have known over a long period of time, versus skilled advisors. And I think skills are at a premium. A lot of the money we are seeing getting managed is around cost. So how do I reduce the cost of managing money? Versus understanding, how do I actually understand various asset classes, and how do I make my money work for me? So my personal view is, setting up a family office or not a family office is actually a function of many things. Is the size of the AUM below a certain number that actually doesn't make sense. Our view is below a 500,000 crore number, that number doesn't make any sense. The cost and availability of talented, skilled advisors who can do actually a good job of advising and managing in a real way doesn't work. And I think also it depends upon how involved the family is in managing the money, and what are they doing with their time. So to me, it's multiple things, but on the balance, I would say the industry is not evolved enough, and the AUMs are not large enough to have, unless the family members are themselves deeply involved and they see this as their own journey of evolution and learning, saying, okay, I got into money, I want to be a money manager, and I would learn like you would learn as an apprenticeship in a business, I think makes sense. But otherwise, I think as a professional, it's still a long way to go.
Yeah, Anuj, this is
Ankit,
for you.
can I add a little bit?
Yeah, of course,
because in our journey, we end up reaching out to a lot of family offices who are wanting to deploy capital. And one thing which I realize is very important to understand, as a family, what is the investment goal? Let's say if I have sold my business for 2,000 crores, do I necessarily want to convert that 2,000 crore to 4,000 crore? There are so many families who are extremely conservative as well, and they are saying, even if I increase my capital by, let's say, 5%, 6%, 7%, I don't want to take risks of any kind. So probably there are then people who are kind of one family member is just identifying what are the right investment opportunities in a risk-free manner. Of late, what I have also realized that if there are large families and there are multiple members in the family and there is clarity of thought process, one family member, probably the younger one, has now made his day job of just doing investments. He's not involved in family business. He's not involved in day-to-day operations or executions. He's just focused on investing the family money. And that's a role which is gaining more and more prominence in a lot of families. And you can pick up a lot of listed company families also. The next generations are not operating, but are part of just doing this as their day job. And then the third element after that comes is, what they try to do is an internal as well as an external. They may have someone who is professional, trusted, and I completely agree, not skilled enough also, to kind of help in managing that. And then partially they need to start giving capital to external people. It may look that it's higher cost initially, but effectively if it's going to skilled people in long term, net of cost the returns is generally higher if it goes to skilled people.
Absolutely.
Yeah, that's how I am seeing slight evolution of even anyone claiming that I'm a family office. That's the progression which a lot of people are taking.
Yeah, so continuing Anuj or Rochelle, so last year in 2022, there were $35 billion for startup funding altogether. And this year it has been significant reduction to $22.5 billion. What do you think has been a significant correction for such a drop in the investment side? There's been almost like 30 to 35% reduction in terms of investment in the startup world.
So to your point, even the 20 odd billion is a decent number of investment which has happened. We are more India-based investors, so can give a perspective from our angle. Definitely, the number of deals has reduced, and more so, let's say at a growth or late stage as compared to the early stage in India. In India, the early stage is still, in my opinion, maintaining momentum because there is domestic capital cropping up every day. It's increasing by the day. And there is a lot of new money which is coming as far as early stage is concerned, which had never come to India. But growth stage is a function of what is also happening globally. It was largely driven by global money. And the money which was coming in India from a few set of players had done a lot of that $30 odd billion transaction. Few set of people, but major capital came from there. They have got impacted in their global portfolios, not so much in India. They have got impacted by global portfolios, and that has reduced the liquidity at growth or late growth stage. Yeah.
Let me add one perspective to this. We deal a lot with digital ecosystem. So first of all, you can't compare last year to the year previous.
Yeah.
If you look at last year FY23 or CY22, it is higher than CY20. So CY21 was a euphoric year. So, the whole industry is growing like this. And then there was a euphoria which came. Two things have happened. In every capital market, whether private or public, there would be periods of time when market will be willing to give you capital. People have loaded up on the capital, so they don't need the money. We just did a transaction with Lenskart, but last week, it was a $500 million transaction with Adia. $400 million was secondary, only less than $100 million was primary, because company does not need the capital. They have already loaded up the money. So I think a lot of the guys already have the capital, number one. So you will start, so it's also a combination of how much euphoric money is available, but it is not a low amount. That's what I want to mention. So it's not something that you should be worried about in terms of the market is bottoming out.
I'll add another additional flavor. I think let's not go with the numbers. If you talk to anybody globally today, in terms of allocating capital, India is still one of the best shining stars out there from global money allocators, right? Whether they want to put money in the US or they want to put money in emerging markets. If it is emerging markets, everybody is positive on India. That's point number one. The second is, if you look at just what has happened to capital raises, take the startups aside, right? One of the best things that has happened in the last few years for private equity as an asset class is the exit environment has become very exuberant, right? So capital that went into private equity, if you talk to any asset allocator, their biggest challenge was, हम इंडिया में पैसा डालते हैं लेकिन वापस आता नहीं है, right? That was always the challenge. But in the last few years, private equity has been able to exit. It may be in euphoric environments, but the capital market has provided that scenario. So what has happened now is that private equity funds, apart from India macro looking very good, is also seen as an asset class where you can take capital out and you can give a return. So while the numbers seem, there is a dip and stuff like that, and to Gaurav's point, one euphoric year, there is always capital available for good quality companies in India.
And therefore, I think, considering the entire sentiment, in fact, this is the best time and vintage to actually do investments and an opportunity per se, as compared to, let's say, 2 years back.
Rochelle, just to add to that, now, for example, Lighthouse has been an investor in Bikaji, right? Bikaji Foods. One of our batchmates from FMB 10, Deepak Agarwal. And if you can just take us through how that, in a concise manner, of course, what has been the journey from say, Bikaner to BSE, which is the famous tagline now. But I think, if you can discuss a few snippets from that journey, but more so, how is it working with a family, where you had to actually show them that big picture? Obviously, Shivratanji and Deepakji, they are extremely big picture thinking entrepreneurs all the time. But then how did private equity investors like yourselves enabled that line of sight for them?
I think this question is best answered by Deepak Ji. Is Deepak Ji in the crowd? If he's not, then I will.
No.
But let me take a stab at it, and maybe you guys can double check with Deepak Ji on what I say. Well, for us, it's been one of the most gratifying journeys, not just because we're talking about Bikaji Foods, but generally if you speak to any private equity fund and you speak to Gaurav as well, I think it's one of those very gratifying stories of private equity for an Indian family. This first goes to the humility of the family, right? They came from Bikaner. There were 400 crores of revenue at that point in time. Absolutely did not require capital. They could have taken debt at that point in time very easily from any bank that they desired. But they had the humility to recognize that if they needed to go out of Rajasthan and they needed to pivot themselves from a regional brand to a pan-India national packaged food brand, then they required certain amount of capabilities. Product was fantastic. They had one facility. Our capital helped them create Asia's largest ethnic namkeen facility. But apart from that, what we helped them realize is actually take on states where there were incumbents who were much larger. So it was just brass tacks of actually understanding sales and distribution 101, and we took on states methodically and grew them up. After we built sales and distribution for 4 years, so we've invested and stayed invested in this company for 8 years. So remember, the capital that private equity brings is also patient. So this is not hot money that comes in and gets out in 2-3 years or so. So you need to provide patience to the business. After about 4 years, after distribution was set and placement was set, that's when we actually opened the tap of marketing for them. So that's why you see the whole Amit ji loves Bika ji tagline, which is out there. We got in, we as in, it was the family who sort of convinced Mr. Bachchan to become the brand ambassador, so on and so forth. So then the rest is history, right? So after sales and distribution, it was marketing. And while we were doing all of this, all the other plain vanilla things, for instance, hiring, thinking about opening an office in Bombay. So they came from Bikaner to Bombay, small things like this. So at the end, these are these small low-hanging fruit that if you address, provides massive levers of growth in the business. I typically tell this to promoters, you have only 2-3 things to correct. See, if there are 10 things to correct, then there is something wrong in the business itself, right? 2-3 things to correct, you correct it, and you're able to get to that growth journey, which is what Deepak ji and Shivratan ji did. And, you know, the IPO is a testament to all the hard work that they did.
Thanks, Rochelle. Just relaying that question, and I'll ask this question to Gaurav and then Anuj again. Rochelle spoke about low-hanging fruits for founders or for promoters to sort of add on to their business strategy and grow the business from there. Also, there are times when promoters sometimes don't understand this insight or choose not to understand, and that then arises conflicts between investors and the promoters. It could be very different for private equity funds like yourselves versus what Anuj does with startup founders. Just want to get a perspective of how to manage this conflict and what's the best solution out of it. I think it's a tough one, but
even if you can share some example also, like.
I think in my mind, the time that when you make an investment is the time you decide the rules of engagement. I don't think you can question that beyond that point in time. So what you set out as who you partner with, on what terms of governance and exit. Where are the conflicts come? Conflicts only largely come on 2 things: business operations and exit. You know, after the investment, there's really no other conflict. And that's actually around, very rarely I've seen conflicts coming in M&A. It's mostly coming around operations and change of personnel, a change of people. You know, and the call any investor has to take at the time of investing is, most of these family businesses are run largely by the family itself. They may have professionals supporting them, title irrespective. They may have a CEO, a COO, a head of sales, etc., but they practically run by the family. And if you are a minority investor, you have bedded your investment behind the family. So if the conflict is around you're not doing well, suck it up. If the conflict is around exit, then unless the family is going against what has been agreed in the agreement, that's the deal. So to me, I think, but the market is getting more and more mature. You know, so if the complaint is around you're not doing well, that's part of the game. If the complaint is around you're not behaving well, then it's a different discussion altogether. So I think, that's the way I see this.
Anuj, you want to take a shot at that?
Yeah, so couple of points which I feel, and more so when it comes to family offices, it's also about succession planning, which becomes critical, and envisaging that. Coming from a family background myself, another important aspect when it comes is how are dispute resolutions going to happen when the businesses are run by a family. Disputes are bound to happen when you are running any activity between founders, between teams, and a lot of stuff. But what is the mechanism of dispute resolution? That, in my opinion, plays a very important aspect. Slowly but surely, it's very critical to have right corporate governance structures or governance structures as such when it comes to managing family, board, as well as management. If these things can be spelled out over a period of time and Another aspect is where you need to give a platform to different family members to express their opinions, express their grievances. It's about giving them the opportunity to be heard. When it becomes too much professional, conflict starts happening between family and management as well. So dispute resolution, governance, and on top of it, in families we see, the parents, and when the succession is happening, it goes to the eldest child, sometimes not depending on the skill, but just because of when he was born. A lot of these things come into play when it runs to family businesses. These things, if they are understood sensitively and spelt out, can definitely help.
I mean, of course, but when you have so much on the table, and obviously both families know what they are signing up for and the investors know what they are signing up for right when they start their first dialogue, most of the time they end up, resolving it reluctantly or peacefully. Then Rochelle, also does that mean that families should equally be participative or mindful of what kind of investment partners to bring on board? And this is the generation today is all about vibe aa rahi hai nahi, feel aa rahi hai nahi, but is that in some way or form relevant to this investment partner choice as well?
That's a fantastic question, and in fact something that I have to solve for day in and day out. I keep telling promoters one thing. Private equity is a marriage with a predetermined divorce. Aap kitna time, you take to find your life partner, right? Your spouse. That's exactly the type of diligence you need to do when you get an investment partner on board. Typically, when I meet families, I typically get questions of what is the level of interference, what is the level of interrogation. These are some of the things which are very valid questions. And think about it, when you get married, you get asked all of these questions, right? It's similar in nature. I love to draw life analogies to investments because that's exactly how it is. Now, as a minority investor, I think there is a certain level of alignment that you need to build in. So I always suggest to founders, if at all in this group, you are thinking or contemplating on raising capital, while the investor spends a lot of time diligencing you, diligencing your books and asking you a lot of questions, I humbly request you spend equal amount of time questioning us, understanding our track record. I would urge you to speak with the founders which the investors have backed to understand how the investors have dealt with points of conflict, because the best way you can understand is by talking to founders who have been through the journey. So I'll give the last point. Typically when founders make a decision to raise private equity, the temptation is to go with a partner who gives the highest value. Right? Because that's always the case, because at the end equity is very precious. But beyond value, I urge you to do that double click on who the investment partner is. Very critical.
Well, last common question before we take Q&A. The unicorns getting IPO listed like Nykaa, Paytm. Unicorn getting listed like Nykaa, Paytm and everyone at that point of time getting over valuation of probably the billions of dollars. Today they are down or plunged to 30 to 40% down. What do you think, what was the realistic valuation? Is it today or how it managed to list it at that valuation? So what has changed from getting 40% less valuation at that point of time in today's time? Is the mindset of the people or the company structure? If you can throw lights on.
I'll start a shot at it.
Yeah.
So I have a fundamental belief on valuation. There is nothing called a realistic valuation. Okay, as an entrepreneur, you and I can drive value creation in the company. Market sets the valuation. It's a choice whether we want to do a deal at that value or not, period. So, you know, there is nothing in my mind, Sumeet, called a realistic valuation. The same business is valued very differently at different points in time by the market. And there are multiple forces playing at it. And every 5 years, you will see cycles, or maybe every 7. Let me give you an example. And let me give you something which, when we started the digital practice in 2010, the market cap of the whole industry was $5 billion, approximately. When the first crash happened in 2015 March or 2015 mid, the peak market cap of the industry in our estimate, and most of the industry was private, so I'm talking about privates, there hardly anything public, maybe InfoEdge was about $35 billion. When the crash happened in March 2022, the peak market cap of Indian industry, private and public, was close to, in our estimate, about $300 billion. It shrunk every time 30-40% before going up again. So the same companies, if they traded, most of the companies don't trade. What happens in the private markets, you don't trade. And what happens in the public markets, marginal trading defines the price. Falguni is not selling at that price. Maybe she will not, doesn't matter. Our estimate is, by the time you'd see the next peak, the Indian digital market cap would be close to $1.5 trillion, which is probably somewhere around 2030. So to me, what is today, what is tomorrow, is no bearing. There's nothing called realism here. It is what it is.
Great.
And just to add, there was trading then, people are buying and selling, and there is trading today, people are buying and selling.
So Sumit, as fund managers, when we are raising capital and we tell investors that probably one of our exit paths is going to be an IPO, and when you post such questions that a $20 billion company has become a $6 billion, it becomes an out of syllabus question for us, actually. You know, so completely agree and echo the thought of Gaurav. A few more things, like the companies, or typically the nature of companies which got listed over the last 18 odd months, there was no comparative benchmarks which have been available to price those companies. So a lot of things are going by perception as well, going by the market sentiments as well, and how the entire industry is looking at it. What has happened in the past is actually kind of, in some manner, I would say, bringing a little bit more rationalization now in the minds of all stakeholders, whether it is promoters, whether it is investors, in case of IPOs, even the lead managers and bankers, because they play a very important role in pricing the stock and bringing it to the market. And let's say the team members, the employees, the vendors. And from that stage, when it comes to growth stage investors like us, it started trickling down to an extent that if I want to exit this company at certain multipliers, market is not going to accept if I position anything. I need to come back and price it in such a manner that the outcome is right for us as investors. Otherwise, I don't get into the company. That's the outlook which is gradually maturing in the market, and very good for the India ecosystem that it's coming so early in our journey. We are probably at the beginning of the second life cycle, maybe, as far as the venture ecosystem is concerned, is what I believe. And compared to global markets, if it's come so early in our ecosystem, it's very good from a rationalization perspective. So we are more optimistic that it's happened, and in future, it should bring the right outcomes. And I think the impact of that you're seeing as far as the valuation of the companies is concerned. Companies which were, the valuations have compressed in terms of the multipliers which they have started achieving. So it's more realistic right now, good for all of us. I would put it in that manner.
Great.
Well, I won't comment on Nykaa and Paytm. See, at the end, pricing is always a slave to the earnings. As long as the company is having earning potential, the price will follow. That's point number one. Second, from a market perspective, if you see the depth of the Indian markets itself from a capital standpoint is also built up. To give a number, in terms of mutual funds, right, which used to be less than 1 lakh crore 20 years back, today is about 40 lakh crore in an overall market capitalization of about 300 lakh crore. So there is a lot of domestic retail money that is going into companies. Now, the number of companies that are above $1 billion of market cap are only about 1,000 companies, not more than that. So all of the money is going into the large and the mid caps. That's why the valuation keeps going up, because that capital can't come into the smaller companies. So there is money chasing only select number of assets. So when you think about valuation, like Gaurav summarized very beautifully, there is no realistic valuation because there are a lot of other factors like the supply of capital as well. So bottom line, when you are investing, the best heuristic to use is earnings growth, and you'll be safe.
Thank you. We would have loved to take questions from the audience, but we are running out of time. But, one quick rapid fire round we want to do with the panelists over here. Given that both Sumit and I, our families raised private equity capital back in 2014. And in each board meeting, it was, the first few board meetings was very interesting because there are terminologies which we've never ever heard in our lives, and suddenly we started seeing those on the presentations and the ask from the board. My favorite one was Goli. Anyone over here who knows what's Goli? Gaurav, you want to take that one, or and maybe also.
What's the question?
What is your favorite private equity terminology which probably may not be known to traditional family business entrepreneurs like ourselves?
I don't know. I think I think capital efficiency, which is ROE, ROCE. But I'm sure that these days, I think before you get into bed with the private equity, they would actually make sure that they, you go through enough diligence to kind of understand that. By the time, I think 5 years back, you did the deal probably 5 or 7 years back. I think that was early in the game. I think these days, ROE and ROCE are, I think, par for course.
Sumit, what is your favorite?
Goli, that. So Goli was like, the first terminology I got once on the PPT. And this I learned from a Bajaj Electrical guys, they were with me. I said, ye kya hai? Like, I thought it's one of the chocolate, but it's come like growth over last year. So, so this is some terminology which I have been using in all the meetings in nowadays.
I think with that we come to the end of this session. I hope you all enjoyed the insights by all the panel members here. Can we have a huge round of applause for them, please?
Thank you. Thank you, everyone.
Thank you so much.